Cell 1. In this cell, we delve into the concept of self-supervised learning in the context of stock trading, highlighting its significance and practical application. The key idea is to create a pretext task based on market returns that allows the model to learn representations from the data itself rather than relying on human-generated labels. This approach is particularly relevant in the complex and interconnected world of trading, where understanding market structure can provide a substantial edge. The workflow begins by focusing on understanding the underlying dynamics of the market, without aiming to predict returns directly. By doing this, the model learns essential representations, which can then be applied to various downstream tasks such as generating trading signals, clustering similar assets, detecting market regimes, and constructing optimized portfolios. Importantly, this technique recognizes that markets function relationally. Hence, success often lies more in ranking investment opportunities than attempting to forecast their exact movements. One of the significant advantages of self-supervised learning lies in its ability to improve the stability of trading signals. Traditional supervised models can struggle when faced with the noise of limited labeled data and often overfit to specific scenarios. Conversely, self-supervised approaches leverage every available time window and integrate insights from all available assets, resulting in smoother adaptations across changing market conditions. As a result, traders benefit from more consistent signals, reduced variance in their predictions, and enhanced out-of-sample performance. This method also resonates with how humans naturally approach trading. Instead of fixating on specific price changes, experienced traders often think in broader terms, recognizing patterns such as sector strengths or historical market behaviors during risk-off periods. Self-supervised learning provides a framework to formalize these intuitive understandings in a scalable format, allowing for more informed and strategic decision-making. Looking ahead, the next cell will likely explore how these learned representations can be practically applied to specific trading strategies, allowing us to harness the insights gained from this self-supervised approach. Cell 2. In this cell, we're setting the stage for analyzing stock performance by downloading historical closing prices for the Dow 30 companies, which are crucial for understanding market trends and making informed investment decisions. This process involves a few key steps, including fetching the data, computing daily percentage returns, and preparing the data structure for subsequent analysis. We start by importing necessary libraries, such as Y-Finance for financial data retrieval and Pandas for data manipulation. Additionally, we take some precautions by configuring Pandas to display all columns, rows, and their content without truncation. This is particularly useful because financial datasets can sometimes be extensive, and seeing everything at once can help in our understanding. Next, we define our list of Dow 30 companies. These tickers represent some of the largest and most prominent firms in the U.S. economy, which makes them ideal for our analysis. Once we have our list, we use Y-Finance to download the closing prices starting from January 1st, 2020. The data is filtered to retain just the close prices, and any rows with missing data are discarded. To gain insights into the stock returns, we calculate the daily percentage change using the PCT change method. This transformation of price data into percentage returns allows us to observe the relative changes in stock values over time. After dropping any missing values from this new dataset, we store the index of dates and the names of our stock tickers for easy reference later. Transitioning to the structure of our data, we convert our returns data frame into a NumPy array, optimized for performance in further calculations. We also capture the dimensions of this array, which tells us the number of time periods and stocks involved in our analysis. Finally, we print the shape of the returns data and display the last few entries, ensuring we can see immediately how our data looks at a glance. This setup is crucial, as it allows for subsequent analysis, particularly in understanding correlations or building models around these stock movements. In the next cell, we'll likely delve deeper into that analysis, exploring how different stocks interact with one another in terms of their daily returns. Cell 3. This cell introduces a fascinating aspect of the masked returns transformer, particularly focusing on how it generates compact embeddings that encapsulate crucial market states. This is significant because it allows us to understand market dynamics, such as whether investors are inclined towards risk or prefer safer assets, which is essential for making informed investment decisions. The logic here revolves around learning to reconstruct masked returns, or predicting a distribution of returns over a specified future period. The key variable in this process is the regime embedding, which captures different market conditions, essentially categorizing them into risk-on, risk-off, and other volatility regimes. By accomplishing this task, the model essentially learns to recognize subtle patterns within the financial data, which can enhance portfolio management strategies by signaling when and how to adjust asset allocations. One innovative approach highlighted in this cell is contrastive learning. Here, the idea is to compare two different views or augmentations of the same time window. The model aims to produce similar embeddings for both. This is particularly valuable, as it allows the model to enhance its understanding of various market conditions within a shorter time frame. However, it's essential to be aware of potential pitfalls, such as overfitting to specific market situations, which could compromise the model's generalizability. As we move forward, the next cell is likely to elaborate on the practical implementations of these embeddings in creating effective portfolio rules, harnessing the learned representations to optimize decision-making in financial markets. This promises to deepen our understanding of how these theoretical concepts translate into actionable strategies. Cell 4. In this cell, we're taking a significant step forward by implementing a self-supervised learning setup focused on a contrastive encoding approach using PyTorch. This setup is particularly tailored to measure and predict asset returns, making it highly relevant for anyone diving into financial time series analysis. We begin by structuring a model known as a window encoder. This model is designed to process sequences of asset returns through convolutional layers, allowing it to capture temporal patterns effectively. By utilizing a series of convolutions followed by ReLU activations, the encoder distills the input into a more manageable representation. Once processed, these reduced dimensions are projected into a lower dimensional space, and importantly, normalized for consistent comparisons. Each of these steps ensures that we're extracting meaningful features from our data while minimizing redundancies. Next, we delve into the info-NCE loss function, which is pivotal for training our model in a self-supervised manner. This function compares embeddings derived from two augmented versions of the input data. The underlying goal is to bring similar representations closer together in this new space, while pushing dissimilar ones apart. The loss computation also includes a temperature parameter to help scale the logits correctly. To prepare our data for this workflow, we define a dataset class, return windows, that manages our time series data. It slices the returns into overlapping windows for a specified lookback period and provides the corresponding future target returns. This structured approach ensures that we have a consistent setup for both training and evaluation. The actual training loop shows how we utilize this setup. Each iteration involves augmenting the input data with noise and a dropout mechanism, which adds variability to our training process. This method not only simulates real-world uncertainties, but also enhances the model's robustness. We then compute the contrastive loss and optimize the encoder accordingly. As we look ahead, the next cell is set to build on these embeddings to turn raw outputs into actionable predictions or strategies. This transition from representation creation to actual predictions is where the core value of our work begins to manifest. It's an exciting progression, as we'll see how these complex embeddings can inform decision-making processes in the financial domain. Cell 5. In this cell, we're performing a crucial check to see if certain variables are currently defined in our workspace. Understanding whether these variables exist is vital for ensuring that our subsequent analyses or computations will run smoothly without encountering unexpected errors. The code is straightforward. utilizing the built-in functionality of Python to assess the presence of the variables enc, ds, dlpred, and pred model within the global namespace. The expressions return a Boolean value, indicating the presence, true or false, of each variable. Effectively, what this does is let us validate our assumptions about the setup of our coding environment before we dive deeper into more complex operations. If any of these variables are missing, it could signify a potential issue in previous steps, such as a failure to initialize or load necessary data, which can halt our workflow later on. It's also worth noting that this cell acts as a safeguard, offering clarity on our environment's state, particularly if we're iterating over multiple cells that depend on these variables. As we move forward, the presence of these variables will likely play a significant role in our next steps, especially regarding how we manage data and feed it into models for predictions or further analysis. Anticipating their existence will help us craft a smoother and more effective workflow, letting us focus on the intricacies of our algorithms without unnecessary interruptions. Cell 6. In this cell, we establish a crucial framework for creating a predictive model that will help us forecast future returns based on a series of historical data points. This process is essential because it enables us to leverage the relationships in our data to make informed decisions, ultimately enhancing our trading strategies. At the start, we set the stage by defining the desired lookback period and the forecast horizon. The lookback variable indicates how many previous time steps we want to consider, while the horizon signifies how far into the future we intend to predict. Subsequently, we construct a dataset tailored for training our prediction model. The return windows class, which acts as a data generator, produces sequences of returns that match our specified lookback and horizon. Next, we define a neural network model called Next Step Predictor. This model consists of an encoder and a prediction head, designed to take latent representations produced by the encoder and transform them into anticipated returns. It's essential to note that we freeze the parameters of the encoder to stabilize the training of our predictor head, ensuring that we only update the prediction layer during training. The training loop iterates through several epochs using the atom optimizer to minimize the loss, which here is computed using the Huber loss function. This choice is particularly robust for regression tasks, as it balances sensitivity to outliers while maintaining stability in gradient updates. Each iteration processes batches of data, updating the model weights while tracking the average loss for performance monitoring. After training, we shift our focus to evaluating the model's predictive capabilities using the information coefficient, or IC, which measures the correlation between predicted and actual returns. The computation considers a rolling window of historical returns, assessing how well our model's output aligns with the true outcomes. Finally, we print the mean IC, standard deviation, and the number of observations used in this calculation to get a sense of the model's performance on unseen test data. This quantitative assessment gives us a clearer picture of how well our model is likely to perform in a real-world setting. Looking ahead, the next steps will likely involve refining our model further and exploring strategies for improving its accuracy and robustness based on the IC results we've just computed. Cell 7. In this cell, we're focusing on the performance evaluation of our predictive model through the information coefficient, or IC, which is a critical metric in assessing its effectiveness. Here, we observe that the test mean IC is approximately 0, specifically negative 0.0038. This suggests that the model's ability to rank returns 10 days into the future is not providing any predictive power within the selected test period. To break this down further, the reported standard deviation of 0.174 over 157 days indicates that while the IC fluctuates, it remains around 0, highlighting the day-to-day volatility but overall lack of predictive consistency. The daily returns we're dealing with are quite small and noisy. The model's attempts to minimize Huber loss, an error metric often used in regression analysis, tend to focus on predicting values that are close to 0. This approach can indeed reduce loss, as it avoids large prediction errors, but it does little to enhance the model's ranking capabilities. It's important to recognize that just because the loss is decreasing, it does not equate to having a trading edge. Here, the true test of success lies in the IC or through robust trading backtests, not merely in lower loss. Essentially, this points to a significant takeaway. Even if we're managing to reduce some errors, we still have to ensure that the model yields actionable insights, which, in this case, it does not. Looking ahead, the next cell will likely delve deeper into these metrics and explore alternative strategies or adjustments that can lead to improvements, harnessing insights from today's analysis to refine our approach further. Cell 8. In this cell, we're implementing a classification framework that differentiates the top and bottom performers among a set of assets based on past returns. This is essential in financial analysis, where understanding the extremes can aid in decision-making and strategy formulation. To achieve this, we define a dataset class that organizes the past returns into windows, along with labels that indicate whether each asset belongs to the top or bottom 30%. The key steps start with the initialization of this dataset class. We import the necessary libraries and set up the structure, defining parameters such as the look-back period, forecasting horizon, and quantile threshold for classification. The return data consists of three parts: the past returns for each asset, the classification labels indicating top or bottom performance, and a mask that helps to ignore the middle performing assets. When creating the labels, we calculate the quantiles for the returns at time t, determining the thresholds that differentiate the top 30% from the bottom 30%. This is achieved with the NumPy quantile function, which provides an efficient way to pinpoint these critical values. The returned labels and masks are one-hot encoded, meaning assets that fall into these categories are marked clearly, while those in the middle are ignored in the subsequent loss calculations. Next, we introduce the classification model itself, which consists of an encoder followed by a classification head. The encoder transforms the returns windows into a latent representation, which is then fed into a series of linear layers that output logits for each asset. This architecture is quite adaptable and allows for a quick adjustment, either fine-tuning just the head or both the head and the encoder. We also define a custom loss function, which uses masked binary cross-entropy. This ensures that only the classified top and bottom assets contribute to the overall loss, making the training process much more effective. As we traverse through the training loop, we monitor the loss across epochs, adjusting our model based on its performance. Looking ahead, the next cell will likely build on this framework, possibly considering how to evaluate the model's performance or integrating more advanced techniques to enhance classification accuracy. This progression not only deepens our understanding, but also sharpens our ability to make informed decisions based on the model's insights. Cell 9. In this cell, we're focused on predicting which stocks will land in the top-performing bucket after training our model. This is significant because identifying top performers can lead to more informed investment decisions. The process we're following involves taking the most recent data window, running it through our trained classification model, and calculating the associated probabilities of each stock being in the top tier. We begin by setting the model to evaluation mode, which is crucial for inference, as it disables elements like dropout that are only intended for training. Then, we encapsulate the latest observations in the variable last window, transforming it into a tensor format compatible with our model. It's essential to ensure that our data is properly shaped. Here, we're adding an additional dimension to comply with the model's expected input structure. Next, we use the classifier to generate logits for these inputs. These logits represent the raw output of the model before applying the activation function. To interpret these outputs as probabilities, we apply the sigmoid function. This transformation rescales the values to be between 0 and 1, indicating the likelihood that each stock will appear in the top 30% at a future time point. After computing the probabilities, we organize the results into a pandas series titled pred top, which is indexed by the stock tickers. By sorting this series in descending order, we can easily identify the stocks with the highest likelihood of outperforming the market. It's valuable to take note of the output. The top 10 probabilities are displayed alongside the bottom 10, allowing us to quickly gauge which stocks might be worth further consideration and which ones are less promising. As we move forward, the next cell will likely build on these predictions, perhaps by utilizing the probabilities to inform strategic decisions or actions. This progression could help us implement a more robust investment strategy, leveraging our model's insights effectively. Cell 10. In this cell, we delve into model scores that represent the probability of various stocks, such as CAT, capturing a place in the top tier of Dow components over a specified future period. Understanding these probabilities helps traders make informed decisions on potential stock performance and investment strategies. To clarify, when we see a score like 0.57 for CAT, it's essential to understand what it signifies. This number indicates a 57% chance that CAT will fall into the top 30% of its peers in the Dow within the next 10 trading days. This isn't a prediction of a 57% increase in price. Rather, it's a classification event framed within the context of the given historical returns. The key factor here is the unconditional base rate, which sits around 30%. Thus, when we observe probabilities significantly higher than this base rate, we can interpret it as an indication that the stock has a better than average likelihood of performing well relative to its competitors. An important detail to keep in mind is that the differences in these probabilities are far more significant than their absolute values. It's the ranking of stocks according to these probabilities that becomes particularly valuable. In practice, traders can utilize this information in a couple of ways. For a top K long-only strategy, an investor might select the top 5 to 10 stocks based on their probabilities, assigning them equal weights in their portfolio. Alternatively, for a long-short strategy, one could go long on the top performers while potentially shorting the lower-scoring stocks, leveraging the predictive power of these classifications. As we move forward, we will likely explore how to implement these strategies effectively, perhaps focusing on backtesting to ensure our approach has robust results. The insights gleaned from this probability analysis will lay the groundwork for those future discussions, making our understanding of stock performance even more actionable. Cell 11. In this code cell, we're diving into a crucial evaluation of a scoring model by calculating the daily information coefficient, often referred to as IC. Understanding how well our model predicts outcomes is central to validating its performance, and that's precisely what this function aims to accomplish. The function named daily IC scores takes in the scoring model, return data, a look-back period, a forecast horizon, and the device for computation. The evaluation process starts with setting the model to evaluation mode, which is essential to ensure that it behaves properly during inference. This is followed by initializing an empty list to collect our IC calculations over time. Through a loop that runs from a specified look-back period to the end of our dataset minus the horizon, the function processes each time slice of data. For each slice, we create a tensor from the recent historical returns, which feeds into the model to generate predictions or logits. These logits are then transformed into probabilities using a sigmoid function, converting them into values between 0 and 1. The next step involves comparing these predicted scores against the true returns that are expected after the horizon. The correlation coefficient between these two sets of values represents the information coefficient, a vital statistic that tells us how well our predicted scores align with actual returns. One important consideration in this process is the handling of finite values. We only keep valid correlation coefficients, which helps ensure robust results. At the end of the computation, we return the mean and standard deviation of these IC values, along with the number of observations, providing a comprehensive view of model performance over the specified evaluation period. As we conclude this analysis, we can see how the insights gleaned from this IC computation can inform future decisions about the model and its adjustments. In the next cell, we'll likely build upon these performance metrics to draw deeper conclusions about the model's efficacy or explore how these scores might influence our strategy moving forward. Cell 12. In this cell, we're analyzing the performance of our model using key statistics to gauge its effectiveness in ranking stocks. Understanding these metrics is crucial because they provide insight into the reliability of the model's predictions, particularly in a fast-moving market like equities. We've calculated the mean information coefficient, or IC, which stands at approximately 0.061. This figure suggests that, on average, our model is slightly better than random chance at distinguishing between winning and losing stocks. However, the standard deviation of the IC is around 0.239, indicating that there is significant variability in its performance from day to day. This level of noise is typical when dealing with stock data, as daily market movements can be influenced by a multitude of factors. Additionally, we have a sample size of 157 days, which is decent for a preliminary assessment. However, it's important to keep in mind that while the mean IC of 0.061 hints at some level of predictive skill, we need further validation before drawing any strong conclusions. The rules of thumb mentioned here can be quite instructive, as they provide a guideline for interpreting the mean IC. A value near zero suggests no ranking skill. Values between 0.02 and 0.05 imply weak but potentially tradable signals, while anything above 0.10 is often viewed as strong, albeit rare for simple signals. In this context, our mean IC is certainly promising, but it also signals that we should proceed with caution. We'll want to conduct further tests to better understand the consistency and reliability of these predictions. This foundational analysis will set us up well for the next cell, where we'll likely dive deeper into validating our results and exploring potential strategies for improving our model's performance. Cell 13. In this cell, we're diving into the calculation of the t-statistic for the information coefficient, often abbreviated as IC. This is a crucial step in assessing the reliability of our signal. By computing the t-statistic, we can gauge whether the observed correlation in our dataset is significant enough to suggest that it's not just random noise. The process begins by using the mean information coefficient, which indicates the average predictive ability of our model, and the standard deviation of this coefficient, crucial for understanding the variability of our measurement. The sample size, represented here by the variable n, provides context, as a larger sample can contribute to a more reliable estimate. In essence, the t-statistic is calculated by taking the mean IC and dividing it by the standard error, which is derived from the standard deviation adjusted for our sample size. This adjustment is vital as it accounts for the uncertainty that comes with estimating our mean from a finite sample. Once we compute the t-stat, we display the result. What's particularly important here is the threshold we consider for significance. If our t-statistic is greater than approximately 2, we have reason to believe that the signal we're examining may not simply be the product of random fluctuations. It's worth noting that while this doesn't provide definitive proof, it does suggest encouraging evidence regarding the robustness of our findings. Looking ahead, the next step likely builds on this statistical foundation, possibly exploring how this t-statistic can inform further analysis or help in decision-making regarding model adjustments or signal validation. Understanding where we are now prepares us for those strategic considerations ahead. Cell 14. In this cell, we're implementing a true walk-forward backtest, a technique crucial for understanding the efficacy of our predictive model while avoiding any data leakage. By using an expanding or rolling training window, we ensure that our model only learns from past information at each step, maintaining the integrity of our performance evaluation. The primary inputs here are the recent days of returns we use to define our look-back window and our target horizon, which indicates how far ahead we aim to make predictions. The goal is to label the top 30% of stocks that will perform best in the subsequent period. This method effectively captures the dynamic nature of the financial markets while focusing on how well our model can identify winners based solely on historical data. As we step through the process, we first train our model using only the data from the past, ensuring we make accurate predictions without any contamination from future data. An important aspect of this methodology is the requirement to purge the last horizon days from our training set to completely avoid any overlap in labels. This is where the concept of leakage comes into play. We then proceed to predict performance for the upcoming period and roll the window forward. This cyclical approach allows us to continuously refine our model's predictive capabilities. Learners should be cautious about how the window is set and how labels are defined, as any misalignment could lead to inaccurate conclusions about a strategy's effectiveness. It's vital to maintain a disciplined approach to data handling to truly assess the model's predictive power. Looking ahead, the next cell will likely build on the results of this backtest, exploring performance metrics and possibly visualizing the results to better understand our model's strengths and weaknesses. This will enable us to evaluate how these predictions stack up over time and refine our strategy accordingly. Cell 15. In this cell, we're diving into a function that retrieves forecasted probabilities from a prediction model, which is crucial for understanding the model's outputs and making informed decisions based on those outputs. The function, called model probs from window, takes in data structured as a window of historical information to generate these probabilities. First, the function sets the prediction model to evaluation mode, which is important because it ensures that layers behaving differently during training, like dropout layers, are now fixed and provide consistent outputs. The input data, a NumPy array representing a lookback window, is converted into a PyTorch tensor. This conversion allows us to leverage the power of GPU acceleration if available, or simply process on the CPU if not. The input tensor is formatted with an extra dimension to align with the model's expected input shape. Next, the function runs the model without calculating gradients, which is essential for conserving memory and speeding up computation during inference. Once the model processes the input, it returns an output tensor that can either represent probabilities directly or logits, depending on how the output is handled. If logits are produced, the function applies the sigmoid activation function to convert these into probabilities, which is a common step when dealing with binary classification problems. The output, regardless of the format, is then detached from the computational graph and converted back into a NumPy array for easier use in subsequent analyses. This step often signifies that we want to utilize these probabilities outside the realm of PyTorch, perhaps for visualization or further statistical evaluation. It's worth noting that if the model is not properly trained, or if the input data doesn't reflect the underlying patterns in the historical data, the probabilities generated here may not be as reliable as we hope. Thus, understanding the model's training process and the quality of the input data is critical. Looking ahead, the next cell will likely build on these probabilities, perhaps by analyzing their implications or integrating them into a decision-making framework, enabling us to leverage this information for practical applications. Cell 16. This cell focuses on implementing a non-overlapping backtest for trading strategies. Essentially, it aims to generate an equity curve based on a specific framework, where trades are executed without overlap over defined time horizons. This method is particularly important for practitioners aiming to test the efficacy of their trading models while managing concurrent risk. The logic of the backtest begins by defining essential parameters like look-back period, trading horizon, and the number of top assets to consider. The primary workflow involves iterating through time steps, where the model analyzes historical data within a specified look-back window to predict asset probabilities. These probabilities are used to identify the top assets that will be included in the portfolio for a given trading horizon. After selecting the top assets, the code calculates the weighted returns based on their equal allocation. It then computes the realized holding period return, which reflects the compounded gains over the horizon. If there's a trading cost per turnover, the code estimates it based on how many assets have changed as compared to the previous holding period. This adds a layer of realism that models trading expenses. Each iteration appends critical metrics such as the date, portfolio return, information coefficient, often indicative of model performance, and the evolving equity value into a results list. Importantly, the code operates with the assumption that trading occurs every specified horizon, ensuring zero overlap in holdings. As it reaches the end of the data, the results are compiled into a data frame that allows for easy analysis and visualization. Finally, this cell concludes by executing the backtest with given parameters and displays the last 10 entries of results, along with mean values and final equity. This effectively sets the stage for future cells that might explore performance visualization or deeper statistical analysis of these trading results. Cell 17. In this code cell, we're implementing a daily backtesting strategy known as the daily ladder, which offers a nuanced way to manage overlapping holdings while accurately calculating daily profit and loss. This method is particularly valuable for those looking to forecast returns over a specific time horizon while still adapting dynamically to daily market changes. The function begins by setting up several important components, including the look-back period, the desired horizon for predictions, and the number of top assets to consider, providing a comprehensive framework for the backtest. By utilizing a DQ, we can efficiently manage cohorts of assets, each representing a specific number of days left for investment. As we iterate through our data, new cohorts are opened daily based on prior returns. The model extracts probabilities from historical data, determining the best performing assets to include in today's portfolio. For each day, we compute the portfolio's return by averaging the returns of active cohorts, which are weighted based on their performance. It's essential to keep track of how many cohorts remain active. If they exceed our specified limit, the oldest ones are removed to maintain balance. Additionally, the function calculates an information coefficient, or IC, which offers insight into how well the predicted probabilities align with actual future asset performance. Output is structured as a data frame, capturing the date, daily portfolio return, IC, total equity, and other key metrics. This produces a rich dataset for analysis, enabling users to track performance over time. As we move to the next cell, we will likely delve deeper into interpreting these results and potentially refine or adjust our model based on the outcomes observed here. Cell 18. In this cell, we explore two different approaches to evaluating trading strategies, illustrating how the choice of method can profoundly impact performance assessment. This is crucial for traders, as the right approach not only shapes their understanding, but also informs decision-making. The first option suggested here involves rebalancing every 10 days to achieve a precise match with a defined label of top 30% over the next 10 days. This method allows for straightforward analysis, focusing solely on non-overlapping performance for that specific time frame. By compounding equity trade by trade, traders can see how each individual decision contributes to the overall outcome, providing a clear picture of the strategy's effectiveness. On the other hand, the second option takes a different route by implementing a ladder strategy that tracks daily performance instead. This approach is more representative of real-world trading, as it accounts for overlapping cohorts and reflects a daily P&L calculation. In this format, equity compounds daily rather than trade by trade, giving traders a dynamic view of their performance that could better align with actual operational scenarios. It's important for learners to notice that the choice between these approaches can lead to markedly different conclusions about the viability of a trading strategy. Depending on their context and goals, traders may find one option more suitable than the other, raising questions about how each could be impacted by market conditions and individual trading behaviors. Looking ahead, the next cell will likely delve into practical applications of these strategies, examining how to implement them effectively and what considerations need to be made to fine-tune them based on backtesting results. This will provide deeper insights that can guide future trading decisions. Cell 19. In this cell, we're diving into a comparison of two options related to the signal quality and financial performance of a trading strategy. The analysis has significant implications for understanding how well a model performs under different metrics and why that matters in trading decisions. We start by examining the information coefficient, or IC, which is essentially a measure of how accurate our forecasts are. For option A, the mean IC is approximately 0.094, with a standard deviation of 0.211 from 145 trades. In contrast, option B presents a mean IC of about 0.087 and a standard deviation of 0.206, drawn from 1,450 daily observations. The closeness of these values suggests that the predictive quality of the model remains strong regardless of which view we adopt, a point that is quite reassuring for anyone using these metrics in practice. Next, we're looking at final equity figures that indicate the performance of each option over time. Option A finishes with an equity of 8.215, while option B takes the lead at 8.656. This disparity is crucial as it highlights that more frequent observations can potentially lead to better financial outcomes, reinforcing the value of extensive monitoring within trading strategies. It's important to clarify what N stands for in each option. For option A, it represents the number of trades, specifically 145 trades, with each trade lasting 10 days. On the other hand, option B's 1,450 refers to daily observations, allowing for a more granular view of data points over time. Understanding this distinction is pivotal, as it can greatly affect interpretability and assumptions drawn from the data. An additional point of interest is the variable called top names, which lists the assets that your model identifies as the most promising options during the rebalance decision-making process. The frequent overlap of these top assets across various days signals a level of consistency in your model's predictions. This stability is beneficial, as it suggests that your model's forecasts are based on meaningful trends rather than random fluctuations in the market. Importantly, this also implies you're not overtrading, maintaining a focused strategy that reacts to historical data rather than noise. As we wrap up this analysis, the next cell will likely further explore the implications of these findings. It could delve into how we can leverage this consistency in our trading strategy, or perhaps how to refine the model for even better predictive power moving forward. Cell 20. In this code cell, we're delving into a comparison of two trading strategies, a walk-forward, self-supervised approach against a straightforward buy-and-hold benchmark. Understanding this comparison is vital because it allows us to gauge the effectiveness of more sophisticated strategies against a basic investment approach, giving us insights into their performance. To establish this comparison, the code first computes the daily equal weight returns from the asset returns data. This is done by taking the mean of the returns across all assets each day. The next step involves transforming these daily returns into horizon period returns, which align with the rebalancing dates of our self-supervised strategy. This is crucial because it enables us to accurately measure the performance of the benchmark against the same time intervals that we're evaluating the self-supervised strategy. The code iterates through the rebalancing dates, calculating the compounded return between each pair of dates. For each period, it gathers the daily returns that fall within the specified range, then calculates the overall return from these daily segments. The result is stored in a list, which is later converted into a pandas series. This series not only holds the returns for each horizon period, but is also sorted by date for clarity. Following that, the cumulative product of these horizon returns is computed to reflect the equity curve of the benchmark strategy. By doing this, we create a clear visualization of how an equal weight buy and hold strategy would have fared during the same times our self-supervised strategy was active. Finally, we align this data with the indices of our strategy results. This way, we can conveniently compare the performance metrics side by side. As we observe the last few rows of our comparison data frame, we gain a better understanding of where the self-supervised approach may excel or fall short relative to the benchmark. Looking ahead, the next cell will likely analyze these results more thoroughly, enabling us to draw definitive conclusions on the performance and viability of the self-supervised strategy in various market conditions. Cell 21. In this cell, we're performing a crucial sanity check to validate the calculations of the equity curves for our portfolio and benchmark. This verification is essential because it helps ensure that our investment strategies are grounded in accurate computations, which ultimately influences decision-making. To delve into the logic, we start by calculating the cumulative product of the portfolio returns. We fill any missing values in the return data with zeros, ensuring that they don't distort our results. By taking 1 plus these filled return values and computing the cumulative product, we derive what the equity should look like if our calculations are accurate. We then compare this derived equity to the equity data already present in our dataset to assess any discrepancies. Next, we use an absolute difference measure to quantify how far off our calculated equity is from the stored equity, capturing the maximum difference for a clear indication of errors. If this value is 0, we can be confident that our compounding calculations are correct. We proceed with a similar verification for our benchmark against the benchmark's buy and hold returns. Here, we again compute the cumulative product of the filled benchmark return data and examine how it compares to the indicated benchmark equity. Once again, we're looking for discrepancies to ensure our results align with expectations. This process not only confirms that our calculations are reliable, but it also reinforces the fundamental idea that both the strategy equity curve and the benchmark equity curve should reflect the cumulative impacts of their respective returns. It's a simple yet powerful check to ensure integrity in our financial analysis. Looking ahead, the next cell will likely build upon these validated calculations, as we may explore performance metrics or further delve into comparative analyses to draw deeper insights into how our strategy stacks up against the benchmark. Cell 22. In this cell, we are summarizing performance statistics for 2 competing investment strategies over a defined period. It matters because a clear comparison between these strategies can inform decisions on which approach yields better returns versus the associated risks. The code defines a function called perf_stats that takes a series of period returns as input. It also uses a default value for periods per year set to 26, which corresponds to approximately 2-week trading periods. Initially, the function removes any missing values from the input returns. It then computes the cumulative product of 1 plus the returns to track portfolio growth over time. Annualized return is calculated by taking the product of the returns, adjusting it for the total number of periods, and subtracting 1 to express it as a percentage. Volatility is measured using the standard deviation of the returns, scaled to an annual basis by multiplying it by the square root of the number of periods. To assess risk-adjusted performance, the Sharpe ratio is computed by dividing the annualized return by annualized volatility, while adding a small epsilon to prevent division by 0. Additionally, we measure maximum drawdown, which indicates the maximum peak-to-trough decline in the portfolio value. The function returns these metrics as a pandas series for easy interpretation. After defining this function, the next step aggregates the performance statistics for both the strategy-labeled strategy and a simple equal-weighted buy and hold benchmark, referred to as EW buy-hold. By concatenating these results into a single data frame, we can quickly visualize how each approach stacks up against one another. The code hints at a significant finding. The performance statistics suggest that the strategy outperforms the buy and hold alternative. Looking ahead, the next cell will likely delve into a deeper analysis of these results, perhaps exploring the implications of the statistical findings or visualizing the performance metrics for enhanced clarity. Cell 23. In this cell, we are defining a function that identifies and retrieves specific data frames from the current environment, which is essential for streamlining our analysis. The goal here is to look for data frames that have required columns like equity, IC, and either portret H or portret 1D, as these indicate critical financial metrics we want to examine. The logic starts with initializing an empty list called candidates, which will store any data frames fitting our criteria. We then loop through all objects in the provided namespace, checking their types. If an object is a data frame, we gather its columns and assess whether it contains the necessary ones. By using the I subset method, we effectively ensure that the required columns are present without needing to manually verify each one, which minimizes the chance for error. Once we've compiled our candidates, the function returns them, giving us a list of data frames that meet our conditions. If no suitable candidates are found, we raise a clear error message, prompting the user to check their data. This prevents confusion and guides the user to ensure that their data frames possess the right structure. Next, we automatically select the first candidate to simplify the process. This choice assumes there may be at least one matching data frame. We print out the name of this selected data frame alongside its data using display, allowing us to quickly inspect its contents. This step is critical, as it lays the foundation for further analysis on the selected results. Looking ahead, the next cell will likely build on this selection by performing analytical steps using the chosen data frame. We will be able to explore financial metrics and potentially visualize important trends or insights, depending on what our selected data frame holds. This sets the stage for deeper financial analysis, informed by the structure we've just established. Cell 24. In this cell, we're utilizing the display function to present the variable CMP, which likely contains some comparative data or analysis results. This step is vital because it allows us to visualize the outcomes of our previous calculations or manipulations, providing a clearer understanding of the results. When we call display with CMP, we're taking advantage of Jupyter's capability to render the variable in a format that's easy to interpret. This might include tables, charts, or any other graphical representation that can help in analyzing the data more effectively. The underlying logic here revolves around making the results accessible and actionable, ensuring that we can discern patterns or insights without needing to dig through raw data. It's critical to consider the type of data contained within CMP. If it's a data frame or another structured format, we're likely looking at a comparison of various metrics or categories, possibly derived from earlier statistical analyses. Assumptions can play a role here as well. For instance, we should ensure that the data has been appropriately pre-processed and is formatted correctly to avoid any confusion in interpretation. Since we're focusing on comparison, we should be attentive to any potential pitfalls. Observing how different components stack against one another can lead to misinterpretations if we don't properly understand the context or the metrics being compared. Each output ultimately serves a purpose. It helps us make informed decisions based on the data. As we move forward, we can expect the next cell to take these insights and leverage them for further analysis or visualization. Perhaps we'll delve deeper into specific comparisons or create a more nuanced representation of the data, allowing us to drive home the conclusions we've drawn from this comparison. Cell 25. In this cell, we're visualizing the performance of our self-supervised strategy in comparison to a benchmark that represents a traditional equal-weighted buy and hold approach. This is crucial because it allows us to assess not only the effectiveness of our strategy, but also how it stacks up against conventional investment methods over time. The code begins by importing Plotly, which is a powerful library for creating interactive visualizations. We initiate a figure object that will serve as our canvas for plotting. Next, we add two traces to the figure. The first trace represents our self-supervised strategy's equity, while the second trace shows the benchmark's equity. Both are plotted over time, using the dates in the data frame as the x-axis. The choice to display these two curves together is particularly insightful. It allows us to visually compare how our strategy is performing relative to a straightforward investment approach. We want to see not just where our strategy stands at various points in time, but also how its trajectory differs from a simple buy and hold method. After plotting the data, we enhance the visual appeal and clarity of the chart by updating the layout. We add a title to encapsulate what the viewer is looking at, label the x-axis as date to indicate the time dimension, and label the y-axis as equity normalized to clarify that the values are adjusted for comparability. By specifying the dimensions of the figure, this output will be visually comfortable and easy to interpret. It's important to note that when assessing these curves, we should be mindful of potential market conditions and other external factors influencing performance, as these might impact the conclusions we draw. As we proceed, the next cell will likely delve deeper into analyzing these results, utilizing statistical measures or additional visualizations to draw stronger insights from what we've just observed. Cell 26. In this cell, we're calculating and visualizing drawdown, which is a critical component in understanding the risks associated with investment strategies. Drawdown essentially measures how much an investment has declined from its peak value, providing insights into the worst-case scenarios an investor might face. To begin with, we define a function named drawdown, which takes a panda series of equity values. The function first drops any missing values, ensuring we're working with complete data. It then identifies the cumulative maximum of those equity values, effectively marking the peak at each point in time. The drawdown is then calculated by taking the current equity value, dividing it by this peak, and subtracting 1, which enables us to express the drawdown as a percentage. Next, we apply this function to two different series from our dataset, one representing a specific strategy and the other serving as a benchmark. This comparison is essential as it helps us evaluate not only how our strategy has performed during periods of decline, but also how it stacks up against the benchmark's performance under similar conditions. Following the calculations, we move into the visualization stage. A figure is created using Plotly, where we add two traces. One represents the drawdown for our strategy and the other for the benchmark. This allows us to visually inspect and compare the drawdown curves over time, offering an intuitive grasp of performance relative to the benchmark. The layout for the figure is also carefully configured, with titles for the axes and the main plot, ensuring that readers can easily interpret the information being presented. It's worth noting that the width and height of the figure are set to specific dimensions for clarity, especially when presenting this data to an audience. Looking ahead, the next cell will likely build on this analysis, possibly delving into further refining our understanding of drawdowns or exploring the implications of these findings on decision-making in investment strategies. This continuity will enhance our grasp of the broader financial landscape and the factors contributing to investment success. Cell 27. In this cell, we're diving into a visual analysis of the information coefficient, commonly referred to as IC, which captures the strength of the relationship between predicted and actual returns. This is significant because understanding IC over time can give us insights into how well our predictive models are performing. We begin by filtering our data to ensure we're only working with valid entries, specifically by dropping any missing values from the IC series. Following that, we calculate the rolling mean of the IC using a window of 12 periods. This choice of window is crucial as it allows us to smooth out fluctuations and recognize the broader trends in our data over time. By plotting both the original IC values alongside the rolling mean, we can visually assess how the forecast's accuracy evolves. In this visual representation, the blue line will depict the IC values, while the orange line indicates the rolling average. Users should be aware that a longer window for the rolling mean could obscure short-term fluctuations, potentially missing out on significant shifts in performance. After setting up the time series, we refresh our focus by constructing a histogram to illustrate the distribution of IC values. This histogram provides a quick snapshot of how frequently various levels of prediction accuracy occur, with the x-axis representing the IC values and the y-axis indicating their frequency. Both of these visual components, the time series plot and the histogram, will help sharpen your understanding of model performance and identify any patterns or anomalies in your forecasts. As we wrap up this exploration, we will likely proceed to examine the implications of these findings further, perhaps linking them to performance metrics or strategy adjustments in the next cell. Cell 28. In this cell, we're creating a visually appealing heat map to illustrate our investment holdings over time. This is important because it helps us quickly assess which assets were held at various rebalance dates, allowing for an at-a-glance understanding of the portfolio's evolution. To achieve this, we begin by constructing a matrix where each row represents a ticker symbol and each column corresponds to rebalance dates. We initialize a data frame filled with zeros. This is where we'll log whether an asset is held at each rebalance point. For every date in our comparison data frame, we extract the top names. Those are the assets we held on that date. If these names are represented as a list or tuple, and they contain elements, we update our holdings matrix, setting the corresponding entries to 1. Once we've populated this matrix, we utilize Plotly to render the heat map. This visualization communicates the information effectively. A cell colored to reflect a 1 signifies the asset was held during that particular rebalance. The layout is adjusted for optimal viewing, with a specific title and labeled axes, making it user-friendly. A key aspect to keep in mind is ensuring that the names retrieved correspond accurately to our ticker symbols. Otherwise, our visualization might misrepresent the true holdings. Looking ahead, the next cell will likely delve deeper into the insights we can glean from this heat map, perhaps considering how these holdings impact our overall performance or risk profile. This progression will allow us to refine our investment strategies based on the visual trends we observe here. Cell 29. In this cell, we're diving into the advantages of self-supervised learning, or SSL, particularly in the context of financial strategies. Understanding why SSL can offer robust insights is crucial, as it enables strategies to excel even amid market volatility and shifts. The key points highlighted here emphasize that SSL-based strategies can effectively identify patterns like rotation, dispersion, and inefficiencies across different sectors. This ability matters because it opens up opportunities that more traditional models might miss, especially when the market behaves unpredictably. The logic is straightforward. Rather than relying solely on highly accurate raw return predictions, SSL focuses on ranking assets and constructing portfolios based on these insights. This means that even if forecasts aren't spot on, the strategy can still provide strong risk-adjusted returns. Moreover, we see that SSL shines during specific market conditions, particularly when things get turbulent. Think of choppy markets or times when correlations between assets shift significantly. This capacity for adapting allows self-supervised approaches to maintain effectiveness right at the moments when traditional models often falter. It really highlights the practical application of these frameworks. They're not just theoretical constructs, but tools for navigating real-world challenges. As we shift to the next cell, we'll likely explore specific methodologies or case studies that illustrate these concepts in action. Understanding how SSL can be applied effectively will deepen our grasp of its potential advantages, making for a compelling continuation of our analysis. Cell 30. This cell signifies the conclusion of our current analysis, wrapping up everything we've explored. It's an important checkpoint, as it gives us a moment to reflect on the insights we've gained and the work we've done so far. In this part of the notebook, it's beneficial to consider what we've achieved. Throughout our previous cells, we've executed various analyses, and this finishing statement helps us gather all our findings cohesively. By summarizing our efforts, we can distill key insights and recognize patterns that may have emerged, ensuring that we haven't overlooked any essential details. One aspect to consider is the assumptions we've made along the way. Whether it was data integrity, the appropriateness of selected models, or interpretations of statistical results, each assumption carries weight. Recognizing these assumptions informs future work, as modifying them can lead to vastly different conclusions. As we prepare to transition to the next part of our exploration, It's essential to plant the seeds for what follows. The next cell is likely to build on the conclusions we've drawn here, possibly introducing new analyses or extending our current findings into broader contexts. This can help in reinforcing the significance of our results and deepen our understanding of the overarching themes at play. As we move forward, we should remain aware of those initial findings to foster a more intricate examination of the subject in subsequent analyses.